thank you for joining our Q1 2026 town hall. As you could imagine, we have a lot to cover today, but I really wanted to make this a very engaging conversation. So what I'll give you some things to do is below our videos, you will be able to chat or raise a hand or even put in questions into the Q&A. Okay, so don't hesitate. Go ahead and put in your questions or any comments, and Sean and I will be able to address them. And I would just say, if you have the question, there's probably two or three others that might as well. Okay, and to go over the agenda to kick off this town hall, first and foremost, we're going to be rolling out a new feature that's going to be in your client portal. I'm really excited for this. It is something that Sean and I have done extensive training on, but it was one of those things that we were going, okay, how do we create an interactive, engaging client experience into your financial future? And so it's going to have a quick video to show you there. And I'm also going to send out the link of that video to all those who attended so that you can watch the video at your own leisure. We had to work through some like audio, but I'm going to do my best. That's why I'm a financial advisor, not a webcast technician, right? But that's why we got Sean. And then what I'll also go into with Sean is 2026 market forecasting. I'll always preface the best thing about a market forecaster is they make fortune tellers look good. We're going to be looking at economic data though, okay? So I think you're going to find that to be very insightful and engaging. And then last but not least, for those who stick around, okay, you got to stick around for this. We're also going to share important numbers in 2026 for tax planning, and that we're also going to email that to everyone that attended as well, so you have access. One of the things that you're going to see is we love engaged clients, and for you being here today, taking time out of your day, is the people we love to serve. We understand if someone's not here, like that doesn't mean they're disengaged. They could be pulled in different directions. We understand that. That's why we do record it, but it's going to be a while before they get the copy of this recording. So you're getting hot off the presses to kick off the new year. And last but not least, you've probably seen a couple text messages and emails, phone calls, passenger pigeon smoke signals to do a 2026 kickoff meeting. If for whatever reason something came up where you couldn't already schedule that meeting, just give us a call or shoot us an email at Team CHS, message us in your app, however you want to get a hold of us. Get back to us and we could go ahead and schedule that 2026 kickoff meeting. So without further ado, client portal going to be able to do is if you want to go in and you want to see some what if scenarios of your own choosing, what if we were to buy a car for this much? Or how about this much? You could do that and you could see how that impacts your own financial plan. And it doesn't change what we have on our side for your financial plan. Pretty cool, right? And for those who raise their hand, please chat in your question, okay? Now, if you like what you updated and you want to make sure we know about it, you could hit a toggle right there on your website, on your app, like your phone app, that will then kick me and Sean over a note saying, hey, you made an adjustment and you wanted us to see it. Think about that connectivity and that communication is something that we're always striving to improve. And by Sean and I deciding with rock, paper, scissors of who's going to pay for the upgrade, and Sean won in case everyone was wondering, it was an easy decision to get you a website, client portal that's going to meet the standards and expectations that we hold ourselves to in our office for the services we provide you. Sean, was there any questions or comments?
It was just about the sound being a bit of a problem. But like Jason said, we'll get that link out to people and it should improve how interactive the portal will be. I know we've got a lot of engineers out there who like to play around with their own financial plans. So this will be a good chance to do that without changing, like Jason said, what's in the base batch. So that should be out after this town hall.
The one that I liked a lot on this is like, if you want to see something in your finances and you want to see that when you log in as like your primary thing, you could customize your client portal now to exactly what you want to see. You want to make some adjustments, you can make those adjustments. Just earlier today, I was working with a couple and they said, we do already do a family trip. We're thinking it's going to be $10,000 a year until let's say age 80. And then after that, then the kids have to pitch in and help out. They could go in early next week and move that number to 85. They could change that $10,000 and move it to 20,000. I don't know, right? It's up to what they want to do. And if they really like it, they could then hit a toggle and kick it over. So more to come. And I'm with the training that Sean and I went through last year in eMoney's premium client portal, there's even a bigger idea is that they were working on for this premium service that we're just both excited for. Now, I'm imagining we're going to get some questions on, okay, I could download the Prime Capital Financial app, right? I could download the eMoney app. How many apps do you want me to download? Well, if you download the Prime Capital Financial app, in that app, you could then go into your eMoney software, okay? Now, on the video that you were watching, they were really heavy on the cell phone because that was the thing that they were really trying to show, like, hey, you could download the eMoney app, use your username and password, and just set it up where you could just log in now with your biometric. That was like part of it. But okay, I'm kind of old school cool, right, Sean? Okay, you see, he didn't agree right away. That's a sidebar. I'm gonna go to my website, right? I'm gonna use this in my website because my eyes are not Sean's eyes, right? I need to see it in a little bit bigger font. Seeing that on my phone, it's not gonna cut it for me. So I got to go to a website, and yes, the same capabilities could be done right on the website. Okay, great questions that are coming in. Before we go into anything else, I want to make sure we are answering those questions. Good, good. Love the engagement. Keep those questions coming. Those questions coming. All right. Do we have any other questions, Sean, that you could see?
Not this one.
Awesome, awesome. So let's get into, I would say, some of the key themes that I'm expecting to see going into 2026. Let me share my screen again. Look at that right there. Coming clear on the screen there, Sean?
Yes, looks good.
Awesome. So the goal for today is we're going to be covering 7 critical themes that will define your investment strategy within 2026. And the approach that we're taking is we'll move beyond the headlines and look at what's actually driving market returns and economic growth. So if you're looking at asset class performance, these are the total returns and annual average returns over the periods that's shown from 2011 all the way through 2020. At the time of this, I think this was in the first couple weeks of 2026. I want to say like a week and a half ago. So what I love working with this group in particular called Clearnomics is they get me updated information on a continual basis. So last year in 2025, looking at this column right here, 2025, you saw that it was dominated by emerging markets up 34.4% and international equities at 31.9%. But take a look at this. Look at emerging markets and where they have been historically, or even the EAFE, that's the international equities, right? You see that they had the time in the sun here, but most of the time they've been down. So they've been lagging quite a bit of the US market historically, and that's been going on really since 2009. So it's been a while since we've seen this, but they were really exceptional last year within the international market. Now, since 2011, the S&P has been the most consistent performer, averaging about 14.2% annually. But I want you to note something. Look at the balance, and that's where that black line is going through, the dark blue balance. That balance portfolio stays pretty typically in the middle, reducing the heartburn of volatility of individual asset class. This goes into just how a diversified portfolio could operate and work and navigate the different investments.
Yeah, now this slide here goes into PE ratio, and that's just price to earnings. And so PE ratio is really just a measurement of how cheap or how expensive the market is. In this case, the S&P 500. So all of the orange marks are 1-year returns, and then all of the blue marks are 10-year annualized returns. And so essentially what this is telling us is that we currently have a PE of 21.9, which is on the high end. Now, that's not to say 2026 can't have a good year in the market. It's just to say that typically for 1-year returns, if you're looking at price to earnings ratio, is a little bit more random. And that's why you see the dispersion. So on the bottom here are all of the price to earnings, starting with 8 all the way up to 26. And then on the left are the returns starting with -40 up to +40. And so what this tells us is that the 10-year trajectory has a little bit of concern just because of the price of stocks. But that's, again, not to say 2026 can't have a good year, because it is pretty common and almost sometimes expected that the 1-year returns can perform better than necessarily what the price to earnings will show. If you look at 2025. That was a pretty unique year in the market. We had what was called a slingshot. So that's, I know, very technical terms, but a slingshot is essentially when the S&P 500 at some point year to date is down 15% or more, and then ends the year by positive 10 or more. And so prior to last year, that had only happened 3 times. And all 3 times the following year, in which case would be 2026, the market was up again. So last year was a bit volatile, as we know, especially around March and April. There are reasons to remain optimistic for the year ahead.
And then when it comes to like a strategy perspective, what Sean and I really focus on with high valuations like we're seeing, we want to be clear, it doesn't necessarily mean a crash is coming tomorrow, right? It just means that we need to be very selective in what investments we're buying into, okay, or holding. So when I say buying into, you got to think a hold is a buy, okay, right? So it's either you're buying or selling, holding is a buy, right? So it's that selection criteria that Sean and I are focusing on along with our investment oversight committee, which I'm a part of that for the firm, being part of the investment oversight committee. Let's look at the sector returns to the year to date. And this is just looking at the different sectors of the S&P 500 with peak to trough return. And so it's just an interesting, like I'll point to one of them, the consumer discretionary. You see the trough here was -1 and it finished at 4.6. Just a few days into 2026, materials and industrials are leading the way at 6.4 and 4.4% respectively. Right, yeah, you're seeing that right there on the materials and industrials. The laggards, utilities is the only sector starting the year in the negative. But what we're looking at is with the market breadth. We're seeing the S&P 500 across the board up around 1.8%, showing a healthy start of the year across most sectors. I think that's a great parlay of what Sean was talking about with slingshot, right? This is an important slide to me. Not to say the other ones aren't important. I feel like this is such an important thing to have a conversation around. And this is about the U.S. productivity and like what kind of growth are we seeing in U.S. productivity. So labor productivity has surged to 4.8%, far higher than the 1.2% average in the 2010s. Now, why does that matter? This is the secret sauce, so to speak, that allows the economy to grow without causing high inflation. To give you some historical context, we haven't seen productivity levels this strong since the 1960s and the early 2000s. Isn't that something to think about? Now, those who've been in meetings with me, they know I like to take my screen share off from time to time and just have a conversation. This is where I just want to just talk for a moment and I'll go right back to the presentation. If you look at GDP growth, historically, it's always been 2%. Well, where do they come up with that number? They look at human capital, right, and labor productivity. Historically, the human capital has been coming in at 0.8. Labor productivity that I just mentioned was 1.2. There's your bogey, 2%. I just met with an economist last Tuesday, and he was going into a presentation beyond just me and him. It was to a group of other Rotarians. And I was really impressed with his presentation, even to we're starting a conversation about him presenting to our clients in a future meeting at the end of February. But what he said in the meeting, I don't know who else knew what he was saying, but I was geeking out. Okay. Imagine that, right? He was saying that human capital is expected to go down to 0.5. So from 0.8 down to 0.5. But labor productivity going from 1.2 to 2.5. That's what he was saying. And you're going, well, Jason, you just showed us 4.8. I like that he was keeping it muted and not looking at a short-term trend, but that puts GDP growth right at 3%. 0.5 plus 2.5, you got 3%. We go from a 2% growth rate to 3. This is around companies looking at ways of creating more productivity, more efficiency, but we're seeing a hit on the human capital side going down, meaning less people to do more work, but leveraging AI to do more work. This is going to be interesting kind of economy, right? We don't have a slide for this. This is why I wanted to take the slides off and just talk to you directly. But imagine if you were me, you're just looking at a screen, right? But I'm talking to you directly on this. Here's what I'm saying is we are expecting what's called a K-shaped economy. Another way of saying it is those who have will have more. Those who don't have, they will feel the pressure. We are also at consumer confidence, we haven't seen the numbers as low as consumer confidence that we've seen since 2000 and 2008. It's been a while. We all know what happened in '08. But what is being seen in this type of economy is those who have money, they're spending money, they're buying things. They see inflation as more of a nuisance and a frustration than as a dire situation. And those who aren't economically, or having that higher income or having money invested in the market, well, they have no faith in this economy because of just inflation over the years and living paycheck to paycheck. And we've seen first-time home buyers hit 40 years old for their first-time home buyer as the average across the nation. So, it's one of those things where, as you can imagine, in one-on-one conversations, if you're wanting to see how can you help the next generation within your family, well, then let's make sure we have those kind of conversations and discussions. But for our clients that are in their 40s and 30s and into their 20s, we're having serious conversations over where to allocate their investments and what to do with their money so they could be able to reach their goals, like our clients that are in their 50s and 60s and 70s who are living out those goals and within being in retirement. Sean, do you want to add anything to there?
No, I think you summed it up quite well.
Okay. You want this one or you want me on this one? CPI?
Yeah, the election year. They'll do the next one.
Okay. Well, so consumer price index, right? It's excluding food and energy, and it's showing a year-over-year percentage of change. Now, why does CPI exclude food and energy? Don't know. It's just, I get the answer. That's what we've always done. That's what we're going to continue to do to keep the data the same. Okay. I got to go with what I'm given. But inflation is cooling with the CPI at 2.7%, with core CPI coming at 2.6. We're successfully moving away from the 2022 peak of nearly 9%. I mean, it's different when you see it on a chart, right? We all felt this, but it's different when you see it just skyrocket look at that trough to peak. Goodness gracious, right? And when it's going down like that, it doesn't feel like it, does it? Right? Because you're still going, well, it's still higher than what it used to be. And what you're saying is correct. Look at where it's at now to what it used to be. Interesting, right? Now, for those who lived in the late 70s, they see that and they go, oh, this was a blip in the radar compared to back then. Well, yes, but now you're nearing or in retirement, and it feels a little bit different when you're on certain asset threshold, right? So, but as we're seeing inflation stabilize, the Federal Reserve has more room to support the economy if and when needed. Now, Sean wants to take on this. I'm going to pass this over. Why don't you talk about the election, Sean?
On topic as always. So yeah, this chart here is really highlighting how the market performs in non-election years, presidential election years, and then midterms. As you can see, there is a trend, even if you take out two of the worst years in recent memory, in '02 and '08, which is the graph on the right. But in non-election years, the average returns are coming in just under 16%. And then presidential election years, they're 11.6. Again, if you take out those two bad years, and then midterms 8.6. So the trend is that midterm years bring slightly lower returns, but keep in mind that the market does have an average, but it's very rare for it to be the average. So oftentimes it'll be a lot higher. But as you guys know, from years of investing, the bad years can be worse as well. So all this to say, the midterm election year tends to be a little bit lower, but overall, the important thing is to stay invested and make sure your strategy aligns really with your goals.
I love what you said. Money is green, it's not blue, and it's not red, right? And I think the color palette that was selected by Clearonomics and the Standard & Poor's kind of reflects some of that. We all know markets hate uncertainty, but once the election path is clear, they tend to perform well. You want me to take this one, or you want to take this one, Sean?
I think it also sums up that money is green and it's not red or it's blue, when you take a look, the blue obviously indicates that a Fed chair was appointed by the Democrats, and the red indicates that a Fed chair was appointed by Republicans. So, regardless of who's in the seat, if you're patient and you stay diligent, you can see that the GDP grows, and obviously that benefits the market as well.
Take a look at the economic data that we have already shared, not the political party in power. Now, we're talking about what goes on in the economy, what goes on to the market. By all means, be actively engaged in politics at your local level if that's something that's important to you and you have a passion for, right? That's not our point. We're talking about your finances and how we look at managing your money. Unless you give us a strong mandate, an investment mandate to change it based off of your own personal political views, then we could do it. But just understand, you have to give us that mandate to do that. And Sean, I could think of only maybe 3 clients, right? I mean, we're looking at less than maybe 2% of all our clients that gave us that, Sean. When I'm looking to my right, I'm just looking at Sean on my screen, but it does happen and we can do it. It's a very rare situation.
For sure.
So here's some definitions and how we come to these things. S&P 500, large caps, mid caps, small caps. What's the MSCI? I explained that earlier. What is the investor sentiment? That's based off a weekly survey. Portfolio risk and reward drift. That's 2009, showing what that looks like. Okay, so you get those definitions and methodologies. And then obviously we have the disclosures that come in and the same information here has been obtained from sources to be reliable, but it's not necessarily complete or accurate. And like it could be absolutely guaranteed. There's no representation of warranty or express implied to make it as fairness and accurate completeness or correctness with the information. You like this, right? The lawyer's page, right? But this is saying don't do what we talked about and just start going like making all the decisions. It's like speak with your financial advisor, reach out to us, see how what we discussed today applies to you directly and specific. Next, I'm just going to transition into now. By all means, please type in your questions. We want to make sure we're addressing anything that's on your mind. This document right here, the 2026 important numbers. When you first look at it, it's a lot of data coming at you, and I understand that. That's coming through just fine, right, Sean? Everyone seeing that? Good. MFJ is married, filing, and jointly. Single is single. Estates and trusts. Imagine that. You got an irrevocable trust. You got some sort of estate situation going on. Look at this. It's a very compressed tax. That doesn't happen very often. In fact, Sean and I worked on a case with Schwab to avoid this situation. Took us a few months, more than we would like to admit. But when we're working with a custodian like Schwab, took a while, but we got it from the estates and trusts tax bracket to the married filing joint bracket for this particular couple. So they weren't overjoyed. It took months, but they were very pleased with the tax savings for sure. So that's what those kind of things see, and you see that spread out throughout. What you will also see is there's some what they call non-itemized below the line deductions. Okay, below the line is below your adjusted gross income, which is like line 11 on your 1040 tax form. So you see here, if you are over the age of 65, per individual gets an additional $6,000 on their standard deduction, as long as they're not within these phase out range. Okay, so if they're over 250,000 on their AGI, they're not going to get that extra 6,000. I get a question on this quite a bit, so I'm kind of picking this one a little bit more in detail. They're like, I got questions like, hey, is our Social Security going to be subject to income tax? The answer is still yes, that is the case. However, what was passed through the One Big Beautiful Bill Act, that's what it's called, it was $6,000 per person that's over the age 65 as a way to attempt to mitigate the taxes on Social Security, but that's only for a handful of years. So if you happen to work and you have overtime, take a look at this. Tips, car loan interest, that was a newer thing, right? Qualified business income, for if you qualify for QBI, that's part of the analysis that Sean and I already do. Now we got tax credits, right? Estate tax. I get the question, hey, if I was to lend money to my mom, like, or my dad, to help out with medical stuff, or if I was to help out my kids, right? It goes both ways. We work with a lot of multiple generations. It's like, well, best way I could describe it is, Sean, I'm going to have fun with you. Rachel, my wife, and I love Sean. I could give Sean $19,000 and I have to file no tax. Rachel could give him $19,000 and we don't have to file any forms. But if I give Sean $20,000 and Rachel gives them $20,000, then we have to file a 709 tax form, and that $1,000 that's in excess of the 19 comes off of our $15 million. Right? Now Sean's happy because you got 40K, right? Now does he have to pay any taxes? No, he does not. It will be Now, if I don't file the 709 tax form, if I don't file the 709, then I would have to pay a gift tax of 40% on that $1,000. Why would I not file the 709? Because I didn't know to do it because no one gave me this piece of paper. Okay. So now you all have it. No excuses. Now, if you want to know what your contribution limits are, the changes that were made there, all that information is on the second page. Any contribution maximums, right? All that information there, right? IRMA surcharges. I want you to be, if you're on Medicare, they look a 2-year look back and I look at what your modified adjusted gross income is, right? And so these are the thresholds. So when Sean and I are thinking about Roth conversions, we're focusing on this chart right here, married filings are only on your taxes, but we quickly go down to the magi on the IRMA, the surcharge, to see can we keep you under certain thresholds if we could avoid it. Okay. Now let's get some questions coming in for anyone who has any questions. While we're waiting for that, Sean, what was that interesting case study that you and I were evaluating for this particular situation on money going into a grandchild's Roth?
Oh, are you talking about the
Yeah.
high income earner? Okay, yeah, so this was something we actually just looked into yesterday. But it's essentially a way for multi-generational planning to be even more tax efficient. So a way to do it, and this is pretty high level stuff, but essentially it would require the parents or grandparents to have some earned income, whatever, it could be $10,000, it could be $20,000, maybe one spouse is still working and one's retired. But anyways, you have to have enough earned income to fund a Roth IRA. You can't be over the income limit and have too much. So how it would work is the kid is a high income earner, they're in the 20s, 30s, 40s, and they send their parents $7,000 to $8,000, which would be the contribution for a Roth IRA. The parent has earned income, so they can now fund the IRA in an account in their own name. And so they put the $7,000 or $8,000 in as a contribution, and then they name that kid the primary beneficiary on the account. So what that would allow is the high income child is now adding to their Roth bucket. The parent, it doesn't change the parent's plan at all because it's going to grow tax free. And that kid is the primary beneficiary. And then it would pass on to them when the parent passed away. So this was something that we actually just looked into this past week. And I reached out to a couple CPAs that we work with, and they already confirmed that it was totally allowed. And the key is just that the parents have some earned income so that they can fund their.
Interesting stuff, right? So think maybe the child is 3 or 4 years old. There's no age requirement. The grandparents, they could put money into a Roth IRA as long as they have earned income at their threshold of $8,000 and just make the child their primary beneficiary. You're essentially creating a Roth IRA for the grandchild. Think about that compounding effect over the years.
Yeah, they could use it way sooner if they wanted to, for college or buying a house, whatever the case may be, because once the grandparent passes on, the beneficiary has 10 years to withdraw it. So they could withdraw it totally tax-free in year 10 if they wanted to.
So there was a question that came in, I think, about the gift tax stuff. You want to let me know what that is?
Yes, we have a couple questions here. One is if you loan a family member 12 grand, would you have to file that with the form that you were talking about?
No, because you're below the $19,000 as a gift. But the verbiage is very interesting written. You loaned it to them. That's a different thing because you're expecting by just the word loan that you're going to get a repayment. So now this is where it gets into call your accountant. Okay. This is how I understand the rules. If you're given a loan, you have to give a loan with an interest rate at a fair market value, because if you give a loan, let's say for 3% and the given personal rate loan is 10, the 7% that you didn't charge on that loan is considered a gift at that time. But no, you would not have to file the 709 because it's below a $19,000 annual exclusion. And you're like, I am now left more confused than what I came in with. It's your question. You said $12,000 loan. If you said I gave a family member a $12,000 gift, do I have to file the 709? Sean, what's our answer?
No.
No. Right? Good stuff. Do we have any
Yeah,
other questions?
Another question. So married filing jointly gets a standard deduction of 32,000, and then if they give to charity, they can get an extra $2,000 added to the standard deduction. Would you be able to touch on that more?
So I like whoever asked that question, but if you're going to ask a question, don't do it anonymously. Just put your name, right? Because it's a very unique question. Okay. Okay. So, and again, consult your accountant. As financial advisors, I could just tell you what the tax facts are, how to apply the tax facts. That's what the accountant comes in on. So you have it exactly right. For 2026, that $2,000 charitable deduction, right, is an above the line deduction, meaning it's on top of the standard deduction. So under the One Big Beautiful Bill Act, with their rules, the tax structure for 2026 has shifted to encouraging giving for those who really don't itemize. So if you itemize because you could do a deduction that's higher than the standard deduction, well, then it really worked out for you. But in a breakdown on this is you got the standard deduction of $32,200 with the charitable deduction of $2,000. Okay. Now it has to be cash, a check, credit card to a public charity that's a 502c3. Okay. Now, again, I could tell you what it is. You want to know what a 502c3 is? Look it up, right? If you're a client, bring it up in a one-on-one. I could walk you through this, right? But yeah, you get the 32,200 plus the additional 2,000. Now, think about this. If you're over the age of 65, got the 32,200 plus an additional 1,650 per person. And then if you really wanted to add some more and give money to charity, 2,000. But I'm very careful on how I have to answer these questions because, right, you take what I said today and you go, well, I'm going to give some stock. I'm going to give some real estate. I'm going to give the car to a nonprofit. Doesn't count. Has to be a cash check or card. Okay. So before you take any action like that, consult with your tax professional. I like the question. I have an inkling of who asked it anonymously. I'll text them later. What other questions do we have?
We have one more about the Roth IRA idea. Someone is wondering, can we open another Roth even if we already have one? The difference would be the primary beneficiary. So the reason that this typically works for people who are in retirement partially, but have enough earned income is because they're not really saving for retirement anymore. So the issue is not opening another Roth IRA. It's being able to fund another IRA because it applies to you and your spouse. And so if you can fund a Roth IRA, you're probably going to do it for your own benefit first. And then later down the road, it would make sense to try this. Would you agree with that, Jason?
I would. And I brought up the case study because, Sean, I thought it was a really fun, different way of thinking about finance. But let's not boil the ocean. Right? You know what I mean by this? Listen, if you're already in retirement, well, you don't have any earned income. So only way you could put money into a Roth is through a Roth conversion. Okay, that's new money. So could you have your kids send you $8,000 and you convert $8,000 into a Roth? Sure. The $8,000 they give to you, not reportable because it's below 19,000, right? So you do the Roth conversion into a Roth IRA, and that's set aside for the darling grandchild, right? What this is about is if you own a business, you could hire the children to be models on your website and pay them $10,000, get full standard deduction, and put $8,000 of what you pay them in, or $7,000, I should say, into a Roth IRA. So business owners have been doing this as long as I can remember. But what about if you're a W-2 employee? Can you do this? What I just said? No. But what can you do is the interesting case study that Sean and I outlined. But I'm going to say this, you better be really well off in your financial situation where you're really saving that money in the Roth for the benefit of the child upon your passing or your grandparents or your parents passing. Because if you're going like, hey, I got to eat ramen noodles in retirement, but boy, oh boy, my 20-year-old kid is living large with their Roth IRA. Does it make sense to anyone that's listening? Probably not, right? This is why it's like, hey, here's a town hall to go over different ideas and concepts and considerations, but it spurs a one-on-one conversation for sure. And then we get your accountant like Sean talked about. Good stuff.
All the questions you got, I believe.
Any other questions? We want to be respectful of everyone's time. So I'm going to launch a feedback, okay? And got the one question that's coming in. How would you rate the overall experience of today's town hall? 5 being excellent, 1 is very poor, right? Second question, how would you rate the clarity and delivery of the presentation? Now, this is purely a question only for Sean. No kidding. Go ahead and answer what you have there. And then the third question being, how likely would you recommend this town hall to a friend or a colleague? I like that question. I would have said someone that you like, right? Like, right? Could you imagine if we had a separate question, Sean? Like, how likely would you recommend this is someone you don't like, right? Like, that could be bad, right? But if it's a high score and you like it, when you get the invite, just forward it on to someone that you think could get additional information and have an engaging conversation with their existing advisor, or reach out to us, for us to have that conversation. And would you like to schedule a meeting is the last question. And I like number 5, where you could type in anything you want. What would you recommend that you want us to discuss in the next town hall? Town halls are done on a quarterly basis, just so everyone knows. But we have a monthly newsletter that goes out. And if you downloaded our app, we are working on making sure we have content coming out on a weekly basis there as well. I really discussed it with the team. I don't want any one of our clients to say, I never heard from my advisor. Right? I can't connect with my advisor. We want to make it where you could connect with us through your app by calling our team or emailing our team, and everyone gets it so that we can respond to you in a timely fashion. The phone calls that came in during our town hall, that's what Reagan and Samantha were able to address, while Sean and I were focusing on this. All right, good stuff. So we have a few more people that have joined that, just sort of finishing up the town hall questionnaire. And so in the meantime, you ever need anything, please let us know. We're here to serve. Anything that involves a dollar sign. Thank you.
Thank you all.
There was a question, are we still going to explore private capital this year? Let me reach out to you directly on that question. That was a good one-on question.